The top business stories live from the Sky News City studio. The UK's largest untapped oil and gas field has been given the green light. We'll be speaking to the head of UK offshore for Equinor, the company that owns a majority stake. David Potts, the man who steered Morrison's out of choppy waters, is leaving after 9 years in the job. And Britons are saving more into their pensions than ever. But is it enough? We'll hear from the chief executive of PensionBee. Good afternoon, this is Business Live with me, Ian King. Britons are saving more into their pensions than ever, according to figures published today. HM Revenue and Customs said that in the 2021 to 22 tax year, individual contributions to private pensions hit a record £11.9 billion, up from £11.7 billion the previous year. Meanwhile, the value of contributions from self-employed workers rose from £2 billion to £2.3 billion. But the figures also revealed a sharp rise in the number of savers caught by annual or lifetime allowances on pension tax relief. Well, joining me now is Romy Savova. She's the founder and chief executive of PensionBee, the online pension provider. Romy, good to see you this afternoon. I mean, this is good news on the whole, isn't it?
It is absolutely good news as we strive to build up retirement savings for the future.
But you've also picked up on the fact that withdrawals from pensions, the so-called pension freedoms that George Osborne introduced, those have also risen.
Yes, and that is to some degree to be expected during a cost of living crisis. Of course, many pensioners will be relying on these savings to fund them through record high levels of inflation.
Of course, though, once that money's gone, it is gone. It's difficult to replenish.
Yes, that's absolutely the case. And hence the news about contributions and preparing ourselves for future retirement is very important. And of course, we mustn't forget that we have a very strong state pension system right now, one that enables many retirees to retire with dignity and ensures that their living standards are protected.
Obviously, you can take the first 25% of your pension tax-free. Are you seeing many people falling foul of that limit as they seek to sort of tap into their funds during this cost of living crisis?
We find generally good awareness of that tax-free lump sum for individuals, and many of them will simply access that and leave the rest invested, knowing full well that they want to defer this expenditure into later life as much as they possibly can and rely on some of their other savings.
Now, it was interesting to note during this year, more than 11,000 people got caught out by the lifetime allowance. They ended up paying £497 million in penalties, vast sum of money. Does this help explain why Jeremy Hunt has abolished the lifetime allowance?
It's certainly one contributing factor. Of course, the lifetime allowance limits had been kept relatively constant for many years, and so people were perhaps accidentally tripped up. And of course, as a country, we don't want to be disincentivizing saving for the future. So I think it's a combination of factors, but certainly more people getting tripped up.
And even more people than that, some 53,000 got tripped up by the annual allowance. Would you expect that to fall now that Mr Hunt has raised the annual allowance from £40,000 to £60,000?
Yes, absolutely. And of course, we must remember that 40,000 or even 60,000 pension contribution is very sizable. However, raising the limits can only help to encourage more saving into pensions generally.
In all then, Romy, what is your overall takeaway from these figures that came out from HMRC today?
Well, it's certainly positive to see contributions rising. We know that they have further to go if people want to enjoy a truly comfortable lifestyle in retirement. I think that there is more to be seen as, of course, the data for contributions ended at the end of the tax year 2022. And so we are keen to see what has happened during the cost of living crisis as it intensified over the year. But certainly the initial signs are quite positive. OK, Romy, we have to leave it there. Good to see you this afternoon. Thank you. Thank you.
Now, the UK government has given the go-ahead for the development of Rosebank, the country's largest untapped oil and gas field. Rosebank is estimated to contain recoverable resources of more than 300 million barrels of oil, and if production gets underway by 2026, it will account for 8% of the UK's total oil production between then and 2030. Well, the decision has attracted criticism from environmental campaigners who'd wanted the government to halt the project. But the North Sea Transition Authority said the grant of development and production consent had been awarded, taking net zero considerations into account. Well, the Norwegian energy giant Equinor has an 80% share of the development. I'm joined now by Arne Gertner. He's the Equinor's Senior Vice President of charge of Exploration and Production International for the UK and Ireland. Arne, good to see you today. You first took a stake in Rosebank back in 2018. Did you ever envisage it would take so long to get approval in this way?
Yeah, well, good afternoon. These projects are technically and policy complex. That is something we are quite used to. And today we are in a way, reaching an important milestone, which we think is important for, UK investment, jobs, and really, for the supply chain as well.
Why has it taken so long, do you think, to get to this point?
Now, first of all, we acquired the operatorship in 2019. Since then, we have worked hard with our partners, the contracting companies, to transform this project and today deliver something which is future fit and actually benchmarks really well across our global portfolio.
Now, your partner, Ithaca Energy, I think you own 80%, Ithaca owns 20%. Will you be splitting the investment in that proportion? It's $3.8 billion in total.
Yeah, that's correct. So the total in capex investment for the phase one is at 3.8 billion pounds, which we split into 80-20.
And in terms of having that capital to hand, are you all set to go on that front?
Yes, we are now set to go ahead. The announcement today also means that we're committing to inwards investment into the UK. As I said, creating jobs, but also making sure that this is a contribution to energy security and the industry as such, and keeping the supply chain also busy for a while to come.
Now, environmental campaigners are threatening a legal challenge to the government's decision today. Are you anticipating hold-ups?
Well, we're not anticipating hold-ups, So our focus now is really to mature the project, and stick to our plans and make sure this will become a good project for us as operator, for our partners, Ithaca, and of course for the UK, and something to be proud about.
So the assumptions that you are making, I mean, we spoke to Ithaca today. They expect production to begin in 2026. That is your assumption too?
So we target 2026, which is a real ambitious target, and we will do everything in our capacity to achieve that target. But we say startup is in between 26 and early 27.
Now, obviously, this is quite a polarising issue. A lot of people were opposed to this development. I just wonder, how is developing Rosebank consistent with Equinor's aim of being a net zero carbon business by 2050?
Yeah, you say it. We are a net zero company, so our trajectory is equal to the trajectory in societies. And we invest heavily into the transition scope. So for each pound we invest into the upstream in the UK, we invest about 2 into the energy transition space. So we are a broad energy provider, especially to the UK, and we will continue to do so. But at the same time, I think we can't lose sight of continuing investment into oil and gas as we still use it in our daily lives.
And put Rosebank into context, if you would please, of your overall operations in UK and Ireland, because you are very, very active on the renewables front as well here.
Yeah, we are. We are actually a company operating 4 offshore wind farms, right? We have pioneered first floating wind farm. We have, we are about to bring the world's largest offshore wind farm, Dogger Bank, on stream online. Very, very eminently. And indeed, we are doing a lot of investments into hard to abate sectors, decarbonizing in heavy industries, in Teesside, in Humber, developing hydrogen technologies and CO2 storage technologies. And all of that goes hand in hand together with our upstream presence, which we just recently have been focusing as well with the acquisition of the Suncor portfolio.
Okay, Arnie, we have to leave it there. Big day for you. Thanks very much for joining us. Appreciate it.
Thank you for having me.
Now, some other business news stories for you. And the chief executive of Morrisons is stepping down in November after 9 years in the job. David Potts is credited with having turned around performance at the supermarket after a tough few years, while taking the business into the convenience sector and relaunching its loyalty programme. He will be succeeded by Rami Baitier, who's formerly the chief executive of Carrefour France. Well, the news came as Morrisons reported that its like-for-like sales, excluding fuel and VAT, during the 13 weeks to the 30th of July, were up 2.9% on the same period a year ago. It was the fifth consecutive quarter during which like-for-like sales at Morrisons have grown. The company opened 122 Morrisons daily convenience stores during the period. It said it's since opened 89 more, taking it to a total of 607. The chief executive of International Airlines Group, the parent of British Airways, said it could be interested in TAP, the state carrier of Portugal, once it's been privatised. Luis Gallego said IAG, which also owns the carriers Iberia, Aer Lingus and Vueling, has wanted to see the conditions for privatising TAP. He told the World Aviation Festival in Lisbon, "We launched IAG as a consolidation platform. We're not one airline, we're a company with different companies. We want to have several brands and airlines under our portfolio, and we're always open to having more big companies, big brands in our portfolio." And shares of leading commercial property companies have fallen today after a leading broker claimed the London office market is in what it called a rental recession. Jefferies told clients that it estimated that London office usage had fallen by 20% due to the rise in hybrid working since the pandemic and the trend towards moving to greener buildings outside central London. It believes 7% of office space in London's West End is currently vacant, rising to 10% in the city. Now, stock market flotations have been thin on the ground this year, but one company which did come to market in April was the US-based brand compliance software company Fidel Partners. The business, whose customers include Marvel Entertainment and L'Oreal, today reported a narrowing of half-year pre-tax losses from $1.3 million to $1.1 million. Well, joining me now is Tarek Fidel. He's the chief executive of Fidel Partners. Tarek, welcome to you. What was the thinking behind the IPO, and why did you choose London?
Yeah, so we were at a natural growth curve in the business where we had been seeing quite a bit of uptake on our technology and licensing software, in particular around brand compliance. And so from a business timing, it was the right time for us, albeit from a market timing, obviously it was probably a more difficult time to try to be going out. As far as why London, we're a US-based company, Delaware C Corp. But we also looked at several different stock exchanges, including US and Toronto, as well as London. We found that the London investor market was a really good mix of international types of investors, as well as investors who understand, the intellectual property and compliance space. Whereas some of the other markets that we've looked at were more focused on energy and mining and things of that nature. And being really an international, minded company, a lot of the business that we do is also conducted in Europe, so in London and Paris, in addition to the US. And so therefore it was just a natural fit for us to look at the London Stock Exchange and AIM in particular.
So for people who may be unfamiliar with what you do, what does software brand compliance mean?
Sure. So we take a specific focus on working with brands to help them stay compliant on their marketing content. And so we've got very large global customers such as L'Oreal, Coca-Cola, and others, effectively that use our software to make sure that their marketing content is in compliance with all of the licensing that they're doing to generate that content. And so when a brand is creating photo shoots or video shoots and productions, they're typically involved with photo licensing, image licensing, music licensing, as well as large talent licensing, whether that's athletes or models or actors, etc. And all of those agreements effectively govern copyright compliance and uses of that content. And the brands are more and more exposed on a daily basis as they're doing a lot more digital video production, image production, and deploying it on social media. And they have to make sure that that content is within their allowable uses effectively.
All right, Tarek, there was plenty more I wanted to ask you, but time is against us, I'm afraid. Thanks very much indeed for joining me this afternoon. Appreciate it.
Thank you.
Still to come here on Business Live, we'll have a look at how the markets have finished up this Wednesday afternoon. Don't go away.
Derna itself has initially had about 30,000 displaced people. So what we mean is people who have actually literally lost their homes and are now staying in temporary shelters. That's gone down to about 20,000, but they've moved out to other areas because Derna is pretty inhospitable at the moment. The infrastructure is very bad there. We were actually told by the Minister of Health when I was there in Derna that they need psychosocial support. The trauma that has been faced, not just by the affected populations, but by the hospital staff. So key doctors and nurses lost their lives. Thankfully, Libyan expertise, medical expertise has come in from all over the country, but they're lacking in basic supplies, including fresh water as well. Severe storm, and that affected the northeastern coast of Libya. I was actually flying in on that day, and the airports were closed. It affected the east the most. Benghazi is the second biggest city in Libya. However, in Derna, there were 2 dams that collapsed, and that led to the catastrophic loss of life and displacement of people. You have an internationally recognized government in the west, in Tripoli, the Government of National Unity, and you have another opposing government in the east, Government of National Stability. This moment of tragedy seems to have brought both governments together. So the Government of National Unity has actually established a National Emergency Committee, and the government in the east has put aside funding to really work on providing the resources that are needed. So I think there's a rare moment of coalescence here where the tragedy has brought people together, the people of Libya together.
It's like Emirates. It's like better. Fly Emirates. Fly better. Thank you.
Well, the oil price has hit a fresh 10-month high this afternoon as concerns over supply tightness heightened. At one point this afternoon, Brent crude hit $96.26 a barrel. That is the highest it's been since the 14th of November last year. Brent crude currently changing hands. Look at that, it's exceeded that, $96.52 a barrel. That's up 2.75% on the session. On the equity markets, well, Europe has finished in largely negative territory. I think I can show you the main indices there. They all are, all in negative territory. The big talking point in mainland Europe today was H&M, the world's second biggest fashion retailer, which actually finished ahead by 3.5% in Stockholm after quarterly results beat expectations. Well, here in London, the FTSE 100 has also finished in negative territory, off 0.2% lower in a broad-based sell-off, some 32 points lower. It would have been 11 points more than that were it not for gains in Shell and BP on the back of that higher crude price. Ocado was the leading blue chip faller in percentage terms, though. Look at that, off nearly 10%. That was on broker comment. While all of the property companies, as mentioned earlier, are also lower. There are not too many gainers in the index to mention, but the engineer IMI finished up 4.5%. That's a supportive broker comment. Outside the FTSE, Close Brothers, the merchant bank, that's rallied 6.75%. It fell by as much as 7% at one point yesterday on its results. So it's clawed back nearly all of that. The cyber security firm NCC, meanwhile, that's another company reporting today, up 2% after predicting a recovery in profits this year. Meanwhile, the motor dealer Pendragon has finished ahead by nearly 12% after it revealed a third bid approach for its business. Well, over on Wall Street, the markets have rallied following a sell-off on Tuesday, but the S&P 500 and the Nasdaq both remain on course for their worst quarter since the third quarter of last year. On the foreign exchange markets, meanwhile, well, sterling continues to drift against the US dollar. It's a sixth of 1% lower just now. Well, joining me now is Lucy Cootes, Investment Director at JM Fin. Lucy, great to see you this afternoon.
Good to see you.
Big spike in the oil price today.
Yeah, indeed. I mean, it seems a long time ago, but, you know, Saudi Arabia and Russian members of OPEC Plus cut oil production, and that obviously increases pressure on supply side. And so we've seen prices rise in response of that. And there is prediction from the International Energy Agency that we're going to see massive shortfall towards the end of this year, so the price is only going to rise. This is bad news for Biden, where he's got an election next year and oil needs to be below $5 to fill your tank. And, you know, and the consumer, it's a tax on the consumer because we have less to spend.
Well, I imagine over in Threadneedle Street, they'll have winced at this, having decided to hold interest rates last month. This is the last thing they want to see.
It is inflationary, but certainly it's more helpful now that we have two measures of inflation, so the core inflation excludes energy. That's the bit that the banks are focusing on rather than those that include energy, so, yeah.
Well, I mentioned Wall Street just now. I mean, it's not been a great third quarter. What do you... Go on.
No, it's been a really tough time for investors. Markets have rolled over. There's much more bearish sentiment. The view is that the Fed certainly is going to hold interest rates higher for longer. The view, instead of a cut later this year, it's going to fall into next year, and it's probably going to be in the second half of next year. And at the moment, markets are grappling with that and how it impacts on companies. And we're certainly seeing some companies are going to have to start to raise prices because they've looked at the input costs, they've done all they can, you know, and so it's bad news generally for markets.
What are you looking for in the Q3 earnings season, which I guess we'll get to over coming weeks?
Well, on the other side, actually, corporate balance sheets are healthy. Companies are quite confident. So I'm quite positive from a company-by-company perspective that companies are delivering on their earnings. I'm not expecting any surprises. They're quite nimble. But markets, they're still hugely sensitive to the narrative from the Fed.
Yeah, and especially those tech stocks because their future cash flows are discounted when rates rise.
Exactly. But I do think we're nearing peak rates. Certainly, I mean, I'm not the expert, but everything I read, we seem to be there or thereabouts. You will get one or two outlier comments, but I think we're just grappling with how long and how high they're going to remain and how then that, because it has a lagged effect on the consumer, and whether that pushes into recession. So there's a lot of worries.
You are an expert, Lucy. That's why we have you on the programme. Dave Potts going at Morrison's today. Now, it's no longer quoted, but it was for a number of years. good achievement on his part.
Absolutely, good tenure, 9 years. That's a long time to be head of a company. He's had a very, very good tenure with good results. But there is a change of ownership. There's a change at the top, and that will unsettle, I think, and perhaps he has a different view from where the next steps of the company, and maybe his mandate was, let's get the deal done, and then I'm going to pastures new.
Yeah. Well, he's got a distinguished record to look back on anyway. Lucy, good to see you as ever. Thank you.
Thank you.
And if you want to read more about the chief executive of Morrison standing down, then I've written a piece for the Sky News digital platforms right now on David Potts. If you screen that QR code on your screen, it will take you straight to it on the Sky News website and our other digital platforms. Well, that's it from me for today. I'm back with our morning edition at 11:30 tomorrow. Hope very much to see you then. In the meantime, do stay tuned after this short break. Mark Austin is coming up with the News Hour. Thanks for joining me today. See you tomorrow. Cheerio.